Cool. This one is going to be on the nitty-gritty, realistic expectations. How should you expect progress to look? What kind of returns should you be looking to make? We'll go into, what's the difference between best scenario, wild promises, and then, realistic expectations, real life. What kind of portfolio returns, what kind of money can you expect to make trading in this manner? Disclaimer as always, this is not financial advice. I'm not a licensed financial advisor. Everything here is for educational purposes only. What are realistic expectations of returns as an intermediate trader? So, once you get that baseline competency under your belt, kind of the education phase is over. Like what should you be looking to make? And then, is the 2 to 4 year expectation to reach this stage accurate? Um, so on the topic of weekly returns, that'll mainly be, what this focuses on. Um, as far as the intermediate trader stage goes, we'll say that, the portfolio returns that get you financially to the intermediate stage should look like something that can support you, going full-time trading, and taking over your full income source. So either being able to be the one thing you focus on and live off of, or, be a profitable business that's worth your time to run on the side. And maybe you maintain a primary job or other employment for other reasons other than financial. But really looking at the goal of getting to the intermediate stage is like the financial independence outside of returns you're able to bring in from trading. So as far as estimating, what should re weekly returns look like and what's realistic there? There's back testing, which is, applying your signals to a chart over time in the past and coming up with what those returns actually look like. And then there's something called the decay factor, um, which is a concept applying for the sake of, how do we get from back-tested data to realistic expectations? And the difference between those two we'll call the decay factor. As the name implies, there's an element of decay. Like things are not always going to be in that, perfect trading world where you're able to, 100% run a system 24/7 and get and keep all the returns that you make from that. There's some amount of real world decay that goes into, the translation be between theoretically what a system is and then what the actual output in, real life looks like. So this is based on, um, fairly approximate, a little bit theoretical, what my system looks like over the last week. It's now the Tuesday after Christmas, so I looked at Monday, which was Christmas Eve, through yesterday. Um, I'll get more into, the specifics of my trading style and, what exactly these things mean, but more or less there are three like sizes of ranges for the range chart that I look at. So the 64 range is a more high time frame view, and then 32 and 16 are getting to be lower time frames, so more movements over less time and more zoomed in. So the high time frame 64 range strat over the last week ended up at about 9R. Um, as far as terminology, the R is what you risk for your trade. Um, my strategy is, 3 reward to 1 risk. So, whatever the amount of your portfolio is that you're risking on each trade, over the last week, we made 9 of those based on the 64 range strat. In practice, for the sake of this example at least, I'm having an R be 2%. So for each trade taken on the 64 range time frame, it was 2% of the portfolio risked. For the 32 range time frame, it was also 9R that it yielded. I'm saying that an R represents 1%. So if I was taking trades on that time frame, I would be risking 1% of my portfolio. And then the 16 range, which is the zoomed in, lower time frame strat, uh, that gave 18R. Um, and for the sake of this example, I'll say an R was 0.5%. So over a week, this is quite a lot. And this is, every trade that possibly could have been yielded. So, trades in the middle of the night, um, trades when I was on vacation with my family and all of that sort of thing. This is the raw, maximum that you would have gotten from this system running it perfectly over the last week. So in actuality, um, I took two trades that won on the 64 range time frame. So that was a 6R gain because each was, one risk to three reward. So two times three is six. Using the 32 range strat, I, you know, missed some, got a little bit, ended up a little bit positive. And then just because like there was a lot of volatility and a lot of false signals with the holidays, the 16 range strat kind of just gave a lot of false signals. Um, so I listed it as negative 4R. This is, like actually what I did, doing it just part-time, looking at stuff in the morning and, maybe a couple times during the day while I was on my holiday. Pretty, I think fairly realistic in terms of, what you can actually expect to be doing on a weekly basis. I wasn't working, but I was on holiday, so, it's a little bit weird there. And then price action was just weird with the holidays. Um, I definitely got some bigger trades than I could have otherwise, just because things pumped a bunch on Christmas Eve and then dumped after Christmas. And that was pretty predictable. Um, so examining the difference, if we go back to this, multiply the 9R times 2% is 18% gain, and then 9 times 1 is 9, so 27, and then half of 18 is another 9, so 36% overall. And then this, 12 plus 3 minus 4, which is 11% overall. So why did I end up with this difference? The 30% was given theoretically, and I made 11% of a gain on my portfolio actually by trading. So doing the math, we get a decay factor of 31, 0.31 here. Um, so 36 times 0.31 equals 11 is how you get that. Just doing some algebra. I shorthanded here. So going back earlier to, back testing times decay factor equals the realistic return. We found that here the decay factor was 0.31. So 36% from back testing times the decay factor gave 11% of my, realistic return. So what that ended up being in practice last week. So why was the decay factor what it was? Obviously, I was asleep. I could have been working another job. In this example, I was on holiday, but kind of the same difference there, that there's just going to be some amount of loss, some amount of inefficiency, if you're not catching every signal because you're doing other things. Human error, in retrospect, the patterns might be easier to see than they could have been in the moment. Um, just could be like, the trend looks stronger once you have all the data there that you can see. At the time, you may not have interpreted what you were seeing completely accurately. And that's kind of in line with the discretionary trading. So, maybe the signal is telling you to long, but you have a short bias, but then it ends up going up, or vice versa. Last week, the discretionary trading side probably ended up like decreasing the factor of decay, just because, with the Christmas Eve pump and then the dump right after Christmas, that was pretty predictable. So I actually probably ended up getting better returns based on not completely following the system and doing some stuff based on discretion. Overall, like you have to be at a pretty confident, like pretty good level of trading to where discretion is going to actually increase the amount you're making. Usually, running a system that you've tested through your own interpretation will make the system work worse. So my encouragement, at least starting out, is just get as systematic as possible because the discretionary aspect is gonna, increase the factor of decay that you get as far as your returns. So just best to minimize starting out as much as possible. Um, Also, 11% a week is amazingly good. Like nobody out there is doing 11% every week. I don't do 11% every week. It's a good week for me. Um, so if you took 11% a week and reinvested it, that'd be a 227x on your account per year. So you start out with like $10,000. That's, $2,270,000 after a year if you're making these returns. If this is possible, everyone would be doing this. Everyone would do this and be richer than Warren Buffett in, 3 years of trading. So obviously, hitting this 11% a week is not something that is going to be sustainable in the long run. You may get there some, I got there last week, but I certainly don't get there every week. Um, we talked about the decay factor. So what are other factors that are going to eat away at the gains you make? Fees is one. So there's not really going to be any way that you can trade, any futures broker that's going to let you do it for free. The house always wins. And the casino, in the realm of trading in which we operate is the exchanges. So I am on Tradeovate. I have the lifetime membership. I believe it's something like $2.14 for every contract of ES I trade, which, given the margin and the, leverage that that affords you is a very good rate, but um, it is going to add up. And if I take a trade that's 10 contracts, that's $20 that's burnt, you know, over time, that is going to equal at least a few R, probably a couple R out of my gains every week, just in fees. Liquidity, um, probably worth getting into more. Not really going to matter at most of the level that we're talking about for our purposes. Liquidity, comes into factor in that, the infrastructure for trading doesn't is not going to support trading an infinite amount of money. So, on an exchange, there's going to be an order book, and that order book, you know, might have like 100 orders per contract in the ladder near where market price is. So if you go to trade 1,000, you're going to make a fat finger, which is going to make a big wick candle because you're just going to wipe out the book. So you would not be able to trade 1,000 contracts of ES in the way that I'm showing. And at some point, the size of a portfolio you're going to be able to support based on a trading strategy like this, where you're doing, taking and closing trades the same day. At some point, you're going to hit a cap. The cap is high. It's not going to matter for our purposes for a long time. It's probably around like a $10 million portfolio size, like 5 to 10 million. But really, like, not going to be a huge consideration yet. Taxes, you should pay your taxes. Any kind of income you get, the government's going to want to take a chunk. It's not worth going to jail over. So taxes matter for the purposes of trading, and also they don't. The sense that they don't matter is that if you're profitable before taxes, you're going to be profitable after taxes because it's going to be like, taken out of the net return that you have. But it is something to factor in. Maybe the amount of profitability you have without taxes would be worth it and worth your time. But if you're getting taxed, you might just be better off in your normal job. So definitely is a factor in that sense. Also, if you're at the point where you have to pay taxes on money you make from trading, you're making money from trading, and that's where you want to be. So that's a good problem to have. Um, the last bullet here, withdrawing and spending money from your portfolio. Um, I'm saying don't do this yet. The concept is like you want to be earning gains consistently every week and reinvesting them and compounding, like getting that compound interest boost in your portfolio. If you're taking out $100 a week, $1,000 a week, and buying gold chains, buying yourself a car and all of that stuff, your portfolio is just not going to grow the same way. So really, like for the purposes of this course and the education, um, like the education to get to the intermediate trading phase and also the portfolio growth, you really need to be at a place that you don't need to cash money out to spend on living expenses, which is why initially I gave the recommendation, do this on the side while you're working a job that affords you computer access. Just because you don't want to be drawing into your portfolio and taking money out because that's really going to eat up your gains. So accounting for all this, we said, that 11% weekly return I got probably isn't realistic. So it may look more like, 5.5% weekly. We'll say that Christmas week, was a good week for me. So maybe that number will go down a little bit more. So if we say that a 4% like realistic return per week is what we're aiming for, and we're compounding that, we're just keeping our gains in our portfolio, we're increasing risk over time to line up with our portfolio size growth. So, 1% risk on a $10,000 portfolio is not the same as 1% risk on a $100,000 portfolio. And compounding looks like scaling your risk up to match your portfolio size for the same proportionate risk over time. So if you make 4% a week and you compound it, you're looking at a 7.7x in a year. So your portfolio will be 770% the size after 1 year of compounding 4% weekly. So if you start with $10,000, like we're talking about doing, and you grow by 7.7x per year for 4 years, um, just kind of think about it in your head. Like, what do you think that is? Um, because I think our brains really don't handle compound interest and like without actually doing the math behind it, it's pretty hard to estimate where you end up at. So, it's $10,000 to start, and that becomes 77,000 after 1 year. Um, where do we end up doing that 4 years down the line? That 4 years kind of safe estimate I gave in the beginning. Turns out it's a shitload of money. Um, 35,153,041 dollars. Um, so if you're able to hit 4% per week, and do that consistently over time, that's going to be a huge amount of money. I'm not necessarily saying that this is what you should expect to be at 4 years. Some of the other factors we talked about, like liquidity and taxes, will come into account. You might not be working or doing this on the side consistently 52 weeks out of the year. But, as a mental experiment, this is where your brain should be. Um, you want to hit consistent returns, you want to compound your gains, and then over time, that will equal a huge amount of success. And really, there's nothing stopping that from being realistic. As we went through, there's a difference between the wild kind of theoretical side and then what things look like in real life. But if you hit something modest and realistic and do that consistently, you will slowly get rich and eventually you will be set. I think that's it for our purposes today. Hopefully this was helpful. I'll catch you in the next one.